Welcome back to this week's market update. Today is Monday, December 15th, 2025, and we will jump right in. Tech stocks weighed on markets last week, driven in part by Oracle's lackluster earnings, as well as some renewed concerns about overinvestment without a clear path to AI monetization. As of Friday, December 12th, the value-heavy Dow Jones Industrial Average was up just over 1% last week, while the S&P 500 was down about 0.6%, and the Nasdaq down about 1.6% last week. Moving into some economic news from last week, the Federal Reserve held its final policy meeting of the year, delivering the widely anticipated 25 basis point rate cut, bringing the federal funds target rate range to 3.5 to 3.75%. Equity markets initially reacted positively, though momentum faded Wednesday evening into Thursday morning as sentiment was weighed down by the softer than expected earnings from Oracle. With the interest rate cut largely as expected, a lot of attention was on the quarterly summary of economic projections, which shows what the Fed forecasts around GDP, unemployment, inflation, as well as the Fed funds rate there. We can see that GDP expectations were revised upward in all of the forecast years here, with the most drastic change for next year up 0.5% in 2026, up to 2.3% real GDP growth forecasted. The unemployment rate expectations were pretty stable for the coming years. Inflation expectations actually moved down slightly for 2025 and 2026, so that was a good sign there that the Fed thinks they can balance economic growth here, as you can see with the higher GDP expectation with inflation. And then last but not least, the aspect that the Fed can most directly control is the federal funds rate. They have the same expectations as they did in September, with one interest rate cut still expected in the next year. So overall, the SEP was as expected, or actually slightly better than expected in some aspects, such as the GDP revision upward. We'll take a look at the market expectations in the next slide. Looking at the probabilities that the market is pricing in for interest rates in the year ahead, the most likely scenario right now is 2 interest rate cuts and about a 70% chance of 2 or more interest rate cuts when you look at all of these scenarios cumulatively, from 2 cuts, 3 cuts, 4 cuts, 5 cuts, or 6 cuts there. Now, these further scenarios, these more extreme interest rate cut expectations, would be associated with a recession or a severe downturn of some sorts in the next year. So not hoping for these. There's not current data to support that we'll need this aggressive of monetary easing in the coming year. On the other hand, you can see there is a small chance that we'll see no interest rate cuts next year, about a 21.5% chance of the one interest rate cut that the Fed is currently projecting. So it seems that markets are expecting a bit more aggressive monetary policy easing next year than the Fed is currently forecasting. Moving past the Fed meeting and interest rate expectations, we did get the leading economic index declining again in September, continuing a slow softening trend. Strength in equity markets, you can see here, were a support for the index, as well as the leading credit index and manufacturing new orders for non-defense capital goods, excluding aircraft. On the other hand, some major deterrents were consumer expectations for business conditions, as well as the ISM new orders index. Overall, it continues to point to a slowdown of some sort. It's no longer signaling a full recession, but this continues to be a pretty bearish data point among the economic indicators that we take a look at. After hitting a 3-year low the prior week, initial jobless claims moved back towards a much more normal level. For the week ending December 6, claims rose to 236,000, an increase of 44,000 from the previous week's upwardly revised 192,000, which was that 3-year low. This data series is historically very volatile, but the sharp rebound indicates that the earlier low in the prior week was likely an outlier rather than a real shift in labor market conditions. The latest reading brings claims back in line with the recent range. You can see between this 200 to 250,000 level, We'll have to get more data in the coming week as we'll get the unemployment rate and quite a few economic data points that we'll take a look at in the next slide. As I mentioned, it is a big week ahead. We have the unemployment rate coming out, average hourly earning growth, non-farm payroll growth or contraction, retail sales, CPI, the LEI, we'll get another month of the LEI, initial claims, as well as an update to GDP, the third estimate, PCE inflation, and then personal income spending and savings data. So a lot of potential market catalysts in the days ahead before we get the holidays next week. We'll definitely keep a watch on economic data and how the market reacts to all of these items. So that concludes this week's market update. We really appreciate you tuning in and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.